Thanks, Jenny. Now, on the watch list, let's bring in our next guests, and that's the panel. We've got Dryden Pence, the Chief Investment Officer at Pence Capital Management, and Doug Astrop, a Managing Partner at Exponential Investment Partners. Thanks for joining us today, guys. We're talking FAANG stocks, the ones that are keeping this market afloat, it seems like lately. But if you look at this, Dryden, on a stock-by-stock outlook here, you're seeing a little bit of a divergence so far in 2021. Amazon, Netflix, relatively flat on the year, but then you've got Facebook and Google up sharply. Where do you see the opportunities, perhaps maybe on the short side for some of these ones that have outperformed, or do you expect some catch-up with the underperformers?
Well, thank you for having me on, and it's good to see you, Tom. But I think that if there's an opportunity, it's more of an opportunity of looking at the underperformers, things beginning to catch up. Because I think if you look at these holdings, you have companies that are now being treated almost like staples. I mean, when you take a look at the average of the PE ratios, they're kind of these technology companies that are part of the cloud. And like I always say, the cloud makes it rain. When you take a look at these companies, they're being treated a little bit like staples. They're kind of close to PE of Procter & Gamble, yet they have 3 to 5 times earnings growth, a greater level of earnings growth in the years going forward. So I think we're in an environment where some of the companies that have lagged in this actually have an opportunity to begin to catch up as people understand both the stability that they're really part of our life. I mean, the cloud and all of these companies are the infrastructure of the world economy going forward. We all have to have them. So I think you're more in a case, to answer your question directly, you're more in a case of some of these companies that have kind of been a little slower to accumulate during the rest of this year, to be in a more catch-up mode as opposed to trying to take a look at any short positions on anybody else.
And Dryden set us up perfectly here, Doug, because I looked at some of your notes, and I tweeted something out about Amazon today where the stock is down about 15–16% from its recent highs. Post-earnings, it guided a little bit softer, oversold on a technical level here. But if you look at this, you've got Google, Alphabet, and you've got Facebook doing really well this year on digital advertising. Spend out there is really helping these companies. But Amazon's getting in there. What do you think here of Amazon as it's lagging?
Absolutely. Tom, great to see you. And Dryden set it up perfectly. We agree with everything he said. It's been a little baffling how Amazon has not performed very well this year. It's actually down a little bit year to date, down 10% in the last month. And we think that's really simply because they've decided to reinvest in their business a bit more than some of these other companies. And maybe that spooked people a little bit. But anytime Amazon is stuck in a trading range like this, it's always been a fantastic buying opportunity. The company sells for about 3 to 4 times sales, which is very cheap relative to the other FAANG names. And, this is the dominant retailer. They are all about delivering what the customer wants, and the customers love the service. And we think this is definitely the #1 buy right now in this space, because it hasn't done much this year. And as we pointed out, that's always been a great buying opportunity. So we would definitely be buying Amazon here. This is a great entry point.
All right, and Dryden, we've got maybe some regulatory issues coming down the pipeline. Which of these FAANG names is probably most susceptible to that? I mean, we've got Facebook. It seems like in the news once a week that whether it's the EU or the UK or just here domestically coming down hard on these companies, but it doesn't seem to faze investors at this point.
Well, I think you bring up Facebook from having a regulatory risk, and I think of the companies that are there, probably it has the greatest regulatory risk in both its dominance and its circumstance and how it does. But also, I do believe that if you looked at Facebook and they come in and say, boy, you have to break this thing up into 2 or 3 different things, you basically are just going to unleash 2 or 3 other companies that can continue to grow and be dominant in their markets. I mean, so when they broke up Standard Oil, all they did was create a whole bunch of very successful companies. And I think that when you look at Facebook at that risk, that's probably the very long structure. If they're headed in that direction, I think you still kind of look at it in a positive light. Where it is currently is, you have this headline risk. Every day it's something new. Every day it's something different that they're trying to deal with them on. But in the end, you're looking at a third of the globe is spending time on Facebook every month. So I think that you have something that, again, this is the infrastructure of the global economy, and it's grown so fast. Regulators are not quite sure how do we deal with this. Right. But I don't think it's a company that's going to go away. It's one that's going to continue to adapt and work its way around multiple regulatory circumstances on multiple continents with multiple governments. Yeah. But it's not something that goes away.
Got it. And Doug, if you look at this, and I looked at your notes, and Netflix is one that, and I think a lot of people want to kick Netflix out of the FAANG names anyway. Tell me what you're thinking about here with Netflix.
Yeah, that would definitely be out of that group, to us, the one with the most risk. And it's not regulatory risk in this case, it's competitive risk. Mm-hmm. The streaming business is really heated up lately. It's becoming very competitive. Everybody's moving into that space. Disney proved that with the right content, you can quickly establish a competitive threat to the other players, and Disney's done that with their incredible, unique content. And so that's going to get harder and harder for Netflix to be the dominant player. Discovery and Warner are merging, and they're going to be a big threat. And just to give you an example of what's going on, Amazon is buying MGM to bolster their library. Right. And Netflix has just announced they're going to spend $400+ million on 2 sequels to Knives Out, a very modest film. Okay. So that's what they're going to be facing in years to come, is expensive content. All right, guys, great conversation here. Thank you very much. But that's going to do it for the watch list. I'm Tom White, filling in for Nicole Petalides. Thanks for watching, and stick around for Midday Trade.